Who said falling markets are all bad? For some traders, red on the charts means green in their wallets. Let's talk about put option buying, your best friend in a falling market. Hi, I am Pranav VK, an NISM-certified trader and trainer, and your options guide here at StockShaala by Kotak Securities. Now that we have understood what is a call option, what is call buying, call selling, and as well as understood what exactly is a put option, today we are going to delve deeper into put option buying. It's a tool to profit when the markets are falling. A put option gives the buyer the right to sell a specific stock at a price before the expiry date. It's like buying insurance for your stocks. Even if the price of the stock falls, you're still able to sell it at a higher agreed price. So while everyone else is crying about a market crash, a put buyer is saying, "Show me the money." Let me give you a real-life market example so that you understand put option buying better. Here, I want to take an example of TCS, which is currently trading at Rs 3,800. Now I expect the price of TCS to fall and I want to profit from it. So what am I going to do? I'm going to buy a strike price of 3,700 at a premium of 40 rupees. Now when I do this, there are two scenarios that might happen. The first scenario is where the price of TCS is going to go higher, whereas in the other scenario, the price might stay flat or it might go lower. Now let's understand the profit and loss in each of these scenarios. Now considering the first scenario where the price of TCS stays above 3,700, the premium is going to expire worthless and your loss will be limited to Rs 40. Whereas in the scenario 2, now let's understand what might happen. The price of TCS might remain same or go below 3,700. In this case, the premium of Rs 40 will start increasing to the extent of which the price of TCS falls down. So in this case, the profit might be equivalent to 40, or since it is unlimited profit potential, the higher the price of TCS that falls, the higher the profits. To make the second scenario more clear, let me add some numbers to it. So let's imagine the present price of TCS was 3,800. I have bought a strike price of 3,700, but if the price of TCS falls from 3,800 to 3,600, then the premium also will increase equivalently. So the premium which was 40 earlier will now be 240 rupees. So now since I had paid Rs 40 to enter into this specific contract and now the premium has gone up to 240 rupees, my total profit is 240 minus 40, that is 200 rupees, which is my net profit. Here is an amazing fact about put options. Did you know that mutual funds as well as large investors always buy put options as insurance to protect their portfolio during big events? Which means even the pros are using it. They do it so that they can stay invested in the markets even while protecting their downside. So when exactly should you buy a put option? Let's discuss. You are going to sell a put option when you expect a specific stock or an index is going to fall. Or you're going to use it when you want to hedge your existing portfolio. Or even you can use it to speculate and make a profit out of it. But remember, it is still on the buying side, which means you have limited risk, unlimited reward potential, but at the same time you need timing, discipline as well as direction. So here are a few common mistakes while trading in put options. Now many traders buy FAR OTM puts because it has lower premiums, but you should remember that it also has very low probability. It might sound cheap, but at the same time it is very low probable and the chances of you losing money is very, very high. Now if you don't know what exactly OTM or out of the money is, don't worry because I'll be covering that in the upcoming videos. Another common mistake done by traders is basically holding the entire contract until expiry or even overnights. You have to remember that time decay is your enemy and it loses value as in when you hold the contract for a longer period of time. Entering into put option contracts not based on analysis but just on pure gut feeling. If you do that, then disaster is for sure. And finally, like I mentioned, managing theta or time decay is very, very crucial. So if you don't know what it is or how to do it, then don't trade in put options. So let's do a quick recap of what we have learned so far. A put option buyer is going to be bearish on the underlying asset, because of which if the underlying asset goes below the strike price, then the put option buyer is going to make a profit. A put option buyer has limited risk but unlimited profit potential. But it's important for you to remember that the probability of profit for an option buyer is 33%, whereas for an option seller it is 66%. Put option buying is used for hedging as well as speculation, and in fact it is also used by large fund houses as well as investors. And finally, remember that put options buying is time sensitive, so act with logic and not emotion. So if you like this video, go ahead and like and share it with your friends, because in the upcoming video we're going to be covering put option selling in detail. You're watching StockShaala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.